Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. Absolutely no question about what the main headline news of the week has been this week. Obviously, that was the Labour Party's victory in the general election, which saw them returned with a very handsome majority, one of the largest ever in their history. But despite only recording a very small increase in their share of the national vote, indeed, if you exclude Scotland, they barely improved their vote at all, but achieved their majority as voters spread their favours against the Tories and the SNP in Scotland to a wide range of other parties in England at least. The outcome was very much as expected in the polls and in the betting markets. So it was no surprise to see that the market reaction was relatively muted. It's all been in the price for a while. Gilts traded up as yields declined across the whole maturity spectrum, which will be an encouraging first sign for Rachel Reeves as she becomes the first female Chancellor in the UK. Indication that there may not yet be any risk of bond vigilantes coming in to damage their hopes of creating economic stability and returning the UK to a path of sustainable growth, which is their stated objective. The pound actually edged up a little bit and has been performing against the dollar better than most of its European peers. And the equity markets were also in decent form, with the FTSE All-Share up around just shy of 1%, but the FTSE 250, the mid-cap index, up 2.5%. And AIM also finally showing some signs of life, up 1.5%. So some signs that UK-listed companies may benefit from a period of stability in government, as well as what the new government hopes will be a significant increase in private investment. As we covered the issues and challenges that the new government is going to face in our podcast last week, I'm not going to say much more about it at the moment, since we have little new information to go on. The cabinet is still being formed, and policy announcements won't be appearing for a little while yet, and the first budget or economic statement that the government's going to make will not be until at least the last part of September, given the need to involve the Office for Budget Responsibility. So there will be a honeymoon period, and then we will start to be able to judge how successful the new government is in implementing what it says are its plans. This week, as the newspapers are full of coverage of the election and the results, I thought it'd be a good idea, having discussed it last week, to go back and take a longer historical look at the investment trust sector, where we are at the moment. And to do that, I am joined later in the podcast by John Newlands, the investment trust historian, also former head of investment trust research at Brewin Dolphin and other firms in the city. And I'll be joined also by Ewan Lovett-Turner, the head of investment trust research at Deutsche Numis, the broker. More on that in a moment. Looking at the investment trust sector in more detail, well, it was a positive week, and we had winners outnumbering losers by around 3-1 on the 320-odd names that I look at, though a number were also becalmed, didn't really move much over the course of the week. The list of gainers was headed by a couple of special situations, I would say. Castelnau, interesting UK vehicle, was up 29% on the week, and Seraphim Space up 11%. And encouraging also to see some signs of life at Syncona, the medical research and biotech company. It was up 7% on the week. And also, as I said, with the small cap and mid cap indices performing well, it was also good to see a significant number of smaller company investment trusts performing well over the week, and one or two property trusts as well showing good returns, perhaps reflecting the change in the gilts market and the increased expectations perhaps that they're suggesting we'll see interest rates come down before the end of the year. There were also gains from a number of the renewable energy infrastructure trusts. UK Wind, for example, up 3%. Bluefield Solar up just a little bit less. Again, they could stand to benefit from a combination of lower interest rates and evidence that the new government's plans to step up the pace of renewable energy development should, and perhaps will, benefit them. Looking at the losers, well, they were mostly specific situations, but I would single out Regional REIT down again after its rescue rights issue, still trading just above that rescue rights issue price, but still in the wars, I'd say. And also disappointing performance again from the Chinese Investment Trust, reflecting the continuing poor performance of the Chinese equity market. In the news generally for Investment Trust, it was a pretty quiet week, and the most significant announcement perhaps for those interested in the UK equity market was the performance of Castelnau, which reported that its latest monthly NAV had increased from 74p to 99p on the back of a revaluation of Dignity, its largest single holding, which is the funeral services company. Castelnau has successfully reduced its net debt. And shares of both the Aurora Investment Trust, ticker ARR, and Artemis Alpha ATS, which both have major positions in this Castelnau vehicle, also gained on the back of this news. Turning to results, there are only a handful this week, but it was again encouraging to see of that handful of trusts, a number reporting solid double-digit gains in their latest annual results. Monks produced an NAV total return of 17.6%, though that was slightly behind its benchmark. And Artemis Alpha, an idiosyncratic UK specialist trust, up 15.1% NAV total return. And Oryx International Growth, ticker OIG, that's one of the smaller company trusts in the HarbourVest stable, that reported NAV total return of 12.2%. Also reporting AEWU REIT, ticker AEWU, NAV total return of 5%. That's in the commercial property trust sector. This week, for subscribers to the Moneymakers Circle, we have a profile of Schroeder Asia Pacific, ticker SDP, and that will be followed in the weeks to come by a number of other profiles, including Fidelity China Special Situations. I think that's an interesting one to look at. The Chinese market has been very poor over the last period, but is it becoming a buying opportunity? This week I have included a video market review of the first half performance of the investment trust sector and the markets generally. It's been a pretty dull first 6 months on average, but there have been some interesting features within that general picture, and I highlight some of those in that video, which you can access from our website. So as this was a general election week, they don't come around very often by definition, it seemed a good moment to catch up with two well-researched members of the investment trust community, professional investment trust community. That's Ewan Lovett-Turner, who's the head of investment trust research at Deutsche Numis, and John Newlands, well known to many as a historian of the investment trust sector and a former head of investment trust research himself at Brewin Dolphin for 10 years. So if you want perspective on what's been going on, this is the place to come to. So I'm going to kick off. We're recording this on Friday lunchtime. We know the result of the general election, and it's basically pretty much what we expected, both by the pollsters and by the markets. So as a result, it's not entirely surprising that the markets have reacted very calmly to this change of regime. Ewan, perhaps I should start with you. I mean, do you have anything to add to that? What's the feeling at Deutsche Numis this morning?
Yeah, well, I think you sort of summed it up pretty well in that largely expected. The UK markets marginally up, currency markets, I think, very marginally up as well. And the currency's been reasonably strong in the run-up based on markets liking to know what's coming. And I think this was pretty widely foreseen by the polls. And also when you're looking across the continent, you've got more extreme things happening there. So it's perhaps UK relatively dull and as expected. So markets are pretty sanguine about it. We're not really sure. We haven't seen a great detail about what policies we're expecting and the detail of things from the Labour Party. I'm sure that will emerge as time comes by. Certainly, the things like commitments to green energy might be impactful for the investment companies space with significant exposure to renewable energy infrastructure would be a key area to watch, and particularly having some longer term policies of which, if you know what the objectives are and what the funding is to be behind some of these infrastructure renewable type projects, then you can start to build around that in financial markets, as we saw historically. And certainly something that we'll be looking to get on the agenda again with the new government is getting cost disclosures for investment companies back on the agenda. And the AIC have already been emailing around in recent days and today to get that back on the agenda, because that's something that's been really harmful to demand across the sector.
Indeed it has, and I dare say that there weren't many people who, when they were approached by cameras, had said that I'm really upset about the double counting of costs as far as investment trusts are concerned, but you never know. It probably won't be the first thing on their priority list. But basically, I mean, the British electoral system has delivered an interesting result again, so there hasn't been much of an increase in the Labour vote, but they've won all these seats because of the way the system works, and that allows them then to have a strong government. They've got a big working majority, they can get things done, and we'll certainly have a 4 or 5 year government, but it's not exactly a ringing endorsement of what they're proposing. So we're waiting to see what it is, essentially, John, and I guess you, like everybody else, will be interested to see how much they can actually do of what they have said they're going to do.
Certainly no need for a knee-jerk reaction, in my opinion, Jonathan. After all, this sector's been around since 1868. It's had to go through every political hue in terms of government. It's gone through all these wars and all the rest of it. Having said that, I think we need to keep our eye on the ball with regard, for example, to changes in taxation. Our sector has been skewered in the past on a couple of occasions. For instance, when the CGT appeared on the scene, capital gain tax, corporation tax, whatever you call it. And therefore, that's what we need to look out for. Any signs of legislation coming through, and then obviously we'd have to start reacting accordingly.
I guess you work in private equity, you might be a little concerned about what might actually happen to your personal financial position because of if they change, in some cases, non-dom status and the carried interest taxation if you're a private equity firm. But that's not going to have any immediate direct impact on the private equity sector itself. Would you agree with that, Ewan?
Yeah, I think so. The private equity sector is quite an interesting area of the investment company space, and one I've been a big fan of, and that is an area carried interest of which the Labour Party have said that they will be targeting, and I think I agree with you that largely impacting the personal tax position of the private equity partners involved could impact the return environment there, but largely I think for investors in the sector that should be fine, and there has been some sort of moderating of the view there and making sure that when people are genuinely putting their capital at risk, that looks like it would be excluded from any rules, which is key really to fuel that risk-taking attitude. Allows the reward to be taken for that.
Do you have a thought on that, John? I mean, as you say, taxation is always one of the things that could seep through, but I guess there's no question of any private equity trust thinking it might actually want to change its listing or domicile because of what's happening to the tax regime here.
Well, I can only imagine the agony that's being felt, frankly, among some of these private equity investment trusts. In my opinion, there's some incredibly bright people working in that sector, and they've managed to produce some really worthwhile compound long-term returns in terms of net asset value, and yet at the moment the shareholders don't seem to want them, and God knows how we're going to move forward on that.
Right, so there is a question mark there. You've been put out some research recently which you were talking about the private equity sector, and you made quite a compelling case in terms of both private equity as an asset class and also listed private equity as a means to access that. We have had some significant moves since last year, attempts by some of the trusts to narrow their discounts, but it hasn't really followed through much into this year. Some individual trusts have done well, but others are still languishing on very wide discounts, are they not? Particularly the fund-to-funds private equity trusts. But you think that that's going to change anytime soon?
Well, I certainly think it's a compelling opportunity, both in terms of benefiting from those wide discounts and the expectation of further NAV, net asset value growth from the portfolios. And listed private equity has been an area of the investment trust world that has delivered very strong returns over the long term. If you look over the last decade, HgCapital Trust has delivered about an 18% per annum return. HarbourVest Global Private Equity around 17%. Pantheon, Oakley mid-teens % per annum, which compares to 12.5% for the MSCI world, which, given its focus on the Mag 7, has been quite a difficult market to beat, and just 5.8% per annum for the FTSE All Share. So significant outperformance of equity markets is underpinning the investment case, in my view, for listed private equity. And, I think they've been able to do that by focusing themselves on a high quality asset base, often looking at areas where they can invest in companies, take majority stakes in these companies that are generating high levels of recurring revenue streams. A particular focus has been things like software as a service companies, which have been delivering very strong and continue to deliver strong earnings growth in the, for most companies, mid-teens, even organic growth and higher than that if you include the impact of M&A. Also focusing on areas like business services, obviously often regulatory driven cash flows in those sort of areas, which underpins demand. So they've found areas of the market where you see a consistency of demand and therefore being able to deliver earnings growth, being able to add value. I think that's a really important area, it is through the active ownership, through taking majority stakes. Private equity managers have been able to add value through that operational control. So often they have their playbook as soon as they take over a company, and will look to optimize the operating performance, improve delivery of the services, and make sure they're as efficient as possible, and use their experience from owning other companies in various sectors, and importantly, fuel the growth of these companies. Often things like buy and build strategies, so buying smaller competitors and putting them into a larger group you can often buy those smaller companies more cheaply and then benefit from that multiple arbitrage as you put them into the larger group. And also spend money on accessing new markets, internationalizing companies and fueling that growth, which is often difficult to do in other ownership structures. And I think quite significantly, that's allowed private equity-backed companies to actually grow the job creation much faster than we've seen in non-private equity-backed companies. So you perhaps wouldn't expect that. I think private equity gets a bad name for sort of perhaps the incidents that you see of asset stripping or job losses. But actually, studies have shown that non-private equity-backed companies in 2022, I think the latest figures we've got, grew their employment by about 2%, while private equity-backed companies grew by just over 7%. So being able to fuel that growth leads to those wider benefits, such as job creation and employment as well.
So how do we then explain what's been happening in the market? I mean, the private equity sector is, I think, the best performing sector in the first half of this year. But there's a very wide range of experience within that, dispersion of experience, particularly in terms of discounts. You've got things like, obviously, Literacy Capital is trading around par. Oakley Capital is still on a 26% discount, something like that. And HarbourVest still on about 40%. This can't all be down to the cost disclosure issue. What do you think is going on here and why there is this dispersion of performance across the sector, John?
Well, I think Ewan touched upon the problem of public perception here. And I think that certain members of the public associate the phrase private equity with some mega cap deals that have gone wrong, huge headlines in the national press, etc., etc. Whereas we all know, by investing in these private equity investment trusts, you're getting look-through exposure to many hundreds of underlying companies without the specific risk of going into one particular situation, and so on and so forth. So I think that there's still work to be done in terms of explaining that private equity shouldn't be a dirty word. After all, the great companies in the world was Apple, Microsoft, all these firms, they started in somebody's garage or whatever, and they were unlisted for many of their early years, and they often needed private equity support to take them forward to be the global titans that they are today. So I think it's a sector full of exciting opportunities, but it's not well perceived by ordinary investors. And just before I retired from my final firm, I went on the road around all our branches, and I tried to say to these wealth managers around the UK, what about putting in 3 or 4% for your bigger clients, into private equity investment trusts? You've got the diversification, you've got a bit of spare money there, and why don't you give it a go? And honestly, I received very little support for this radical suggestion. So somebody's got to go out and explain these things a little bit better.
And right. That's a very good point from John on the wealth manager community. If you look at their indices, their asset allocation benchmarks, there isn't anything with private equity or listed private equity in particular. And much of the alternative allocation is focused on low volatility and income generation type alternatives. And I think that's missing a huge opportunity, particularly a lot of those wealth assets will be sort of people's pensions or long-term savings. And where you've seen other investors in those areas invest in private equity, it's been very beneficial to returns. If you look, the Yale endowment has over 50% of its assets in private equity of various forms. Ontario Teachers, CalPERS, the US pension funds close to 20%, either 15 to 20%, either target current or targeted. And I think that's a real missed opportunity, that when you've got these assets that are meant to be invested for the long term, is actually taking some exposure to some of these less liquid areas of the market is an area where you can seek to benefit from that illiquidity premium and excess returns.
I suppose that's the thing, goes back to this question we've discussed a fair bit, which is, do you think the boards of these trusts are doing enough? If there is value there to be had, we know that John Singer, for example, the Pantheon made quite a big statement last year and initiated a capital allocation plan, which seemed to be very shareholder friendly, but the discount on Pantheon has come in, obviously quite significantly, but it's still very wide. So do you think the boards are doing enough? We know other private equity trusts to varying degrees have come in behind that. Some have said, been more explicit about what they're going to do with others. But is there a boardroom failure here as well as a wider market failure to recognise the value of these trusts?
Well, boards obviously have a duty to work their hardest for the shareholders. But unfortunately, share buybacks don't seem to have worked terribly well in listed private equity, and the managers clearly aren't keen on them anyway. So we're really in an extraordinary situation here, and we might be looking back 5 years' time once more to set a really good 5-year numbers for some of the companies we've just been talking about, and others will be ruining the missed opportunity, in my view. But it's how we close that gap is unresolved at the moment.
I think the board action, you have seen a material change in attitudes and action in the last 12 months or so, when historically the thought of buybacks and returns of capital was not something that most boards comprehended or thought was an option. I think now you've had a reassessment of what the best use of available capital is. And if share prices are on very wide discounts, then returning that through buybacks is significantly accretive. And it can be quite hard to justify making new investments over buying back your own shares. And you see most funds introduce some sort of policy whereby, whilst discounts are wide, often a proportion of realization proceeds will be redirected into buying back shares. And I think that's a really positive development. I'd say currently realization proceeds remain relatively low. It's still a quiet market from that perspective. But as that picks up, then I think you're likely to see potentially more capital allocated to the buybacks, and that should hopefully be positive in terms of generating accretion and showing investors that the boards mean business, and hopefully they follow through on the promises that have been put in place. And in the medium term, that hopefully should be positive for the scope for discount narrowing. But I think a real game changer will be a bit of a pickup in the realization activity that'll improve valuations for people, so give them comfort on where the assets are currently valued. And the sector has a long record of exits being at meaningful uplifts to carrying value. And I think that's got potential to continue. And that would be very supportive if we can see some of those exits, because it does the double whammy of giving people comfort on the valuations. And now a proportion of those proceeds would be allocated to buyback. So potential for a sort of double positive as that comes through.
I do see there's a potential tailwind waiting in the wings here in the form of cost of capital coming down if interest rates start to reduce. It means that the attractions of our sector generally could improve. And as I say, with the cost of capital and private equity projects is a critical input for them. And therefore, again, on a 5-year view, that's a further reason to detect unrealised value here.
That's a good point you make there. Perhaps, John, using your long historical knowledge of this sector, have you been surprised by the extent to which the change in interest rate expectations has done damage to discounts, effectively caused this wide de-rating that we've seen over the last 2 or 3 years? Obviously, there's a logic behind it, but the extent of it and the scale of it, I think, has taken some people by surprise. Has it taken you by surprise?
Well, when I first came into the industry, which is quite some time ago now, the two figures that were bandied about the most were performance and discount. And then, as we moved into the zero interest rates era, yield became a big factor. We started to see a correlation between discount and dividend yield, and you got all these solar and wind and alternative energy funds issued at 100p, yielding 5%, and people bought them off the page in huge quantities. And then as interest rates have started to rise, the relative attractions have become less, and a lot of these funds have suffered.
But I mean, the average discount, if you like, we got to this very strange position where it was around 2%, which historically is a very high number, or low number, depending on which way you look at it. And it went out to about 18%, I think, on average, partly because the sector has changed. There were far more alternatives in it, and they were more directly affected. But it has been a big change in sentiment, and that must have some knock-on impact on the way that investors regard the sector, because while they should have been aware of the risk of volatility and discounts, when it actually happens, it still comes as a bit of a shock. And that must be a challenge for the sector looking over the next 2 or 3 years.
This might be a bit of a left field observation, but I do feel we're not getting the journalistic support that we used to get. We used to have a journalist, and several of the nationals seemed to be people who were really pushing and pressing. You of course, were one of them on the FT and elsewhere. And I'd like to see us get some more journalists on side. I really feel that they're not doing their job if they're not promoting our sector.
Right. Well, that's an interesting point. I mean, the media does have a part to play in this. But so do the platforms, of course. That's another thing as far as the retail investors are concerned. The platforms are not, or at least historically, not been perhaps overly incentivized to promote investment trusts because they're a bit more complicated to explain and they don't earn as much money from them in some cases. So that might be another factor as well. But you have to say that until 3 years ago, I mean, there was a lot of demand for investment trusts, and that was coming through in the retail market in particular. And every board you talk to says, we've got to get more retail investors in because the pension funds aren't involved anymore and so on. So there is a sort of structural issue. And then there's also the competition from passive funds, which have also obviously been very prominent in the last few years. So there are some challenges for the sector. And it's obviously going to shrink, John, isn't it? We've seen quite a lot of consolidation so far. But from a historical perspective, there's probably still a fair bit to go, would you say, if boards get their act together at least?
Well, I'm probably a bit of an outlier on this one, Jonathan, because I like the quirky characteristics of some of the smaller funds, and I'm slightly sorry to see that aspect going. I mean, I think it possibly it's something you're wanting to cover today, but if you take, for example, Witan and Alliance Trust, these are not small funds, they're both perfectly adequately large funds in my view, and they both had a sort of background and a history and a character that was slightly special to me. And I'm sorry to see that go. But yes, we do have to recognise that economies of scale are vital now. Total expenses and so on are becoming increasingly placed under the microscope, quite rightly so. And sub 250 million investment trusts are finding it hard to establish a place in the world and keep it.
Yeah. And you've been saying this for some time, and you've been calling for more consolidation, and it's certainly produced quite a few results in the last couple of years, different pace in different sectors. But presumably you still think there is more to come?
Yeah, definitely. I think a number of sort of dynamics are happening on a couple of, the subjects you're talking about, the shift in discounts and the shift in the nature of buyers. And we definitely did see, I suppose, the decade from 2010 to 2020, a lot of issuance in alternative income, and demand for that has been sort of impacted by the change in the interest rate environment, and people are reassessing that. And also in the equity space, the equity investment trust, you did end up with quite a growth equity bias to that. And that sort of demand environment has shifted given the change in rates. And we've seen a number of pressures on demand from the buyer base. The wealth management community has consolidated significantly. They've become larger, and some mega mergers of late. In addition, a lot more of the assets are managed on a model portfolio basis. And both of those trends point more towards high levels of trading liquidity. And also within those mandates, fees have been very much in focus. And the trusts have been hit by, it's a little bit different to putting an order in for a daily dealing investment open-ended fund versus an investment company where you might need to work a little bit more to trade things over time. And also the kids cost ratio be pretty onerous on the trust. So that's been impacting the demand side of things, particularly from those wealth managers. And also you've had the impact of multi-asset managers who are big investors in the sector looking at traditional fixed income as an alternative to investment companies, and also seeing massive outflows themselves from their funds. And all of this has been impacting demand of late. And you see a cash-strapped retail investor who is no longer sitting on COVID windfalls and instead is facing a cost of living crisis. So that's all been big headwinds in recent years. And now we've got interest rates. I don't know where or how swiftly they move from where they are now, but I think certainly an element of stability, which makes valuing the assets a little bit easier, and people sort of learn to live with a new normal, and perhaps you can get back to a level where you start seeing sort of more retail investment flows into the industry, which would, I think, be a big game changer in just flipping that marginal demand. And, in some areas we are seeing people trying to look in areas like listed private equity and take a bit more interest and increase allocations, but they often need a bit of an inflow into their own asset basis to fuel a meaningful increase in demand.
John, we have lost a couple of, as you say, venerable names. We were losing Witan. Scottish Investment Trust went out of business, effectively taken over by JP Morgan a couple of years ago. Are there any other kind of really of the old vintage trusts that you think might be at risk now?
Slightly tangential answers as usual, Jonathan, but I mean, you have to change to survive. And a great example is Scottish Mortgage, which I'm old enough to remember that this thing used to be what we used to call a big, boring generalist fund with all these FTSE giants heading the portfolio. And it evolved, certainly when James Anderson became manager, changed completely in my view. And he, well, you know the story, but I mean, he was one of the earliest investors in the UK to recognise the potential of Amazon and Tesla. Absolutely astonishing. But the point is, he and the board, in conjunction, turned a boring, middle-of-the-road, average performer into an all-time great, which I think I'm right in saying at the peak was something like £18 billion, well set into the FTSE. And he did it by thinking outside the box and moving on.
Well, I guess you could say, having read your history of investment trusts, which is, of course, required reading for anybody who's an investment trust investor, don't miss it if you haven't read it. I mean, I guess it's fair to say that there's probably not a single trust that's still doing what it was when it started, if you go back to the ones that started before the First World War. I mean, they were all investing in bonds in those days at the beginning and so on.
Well, I'll give you an example. They all had this thing called Liebig's extract of meat in their top 10. And I think this must have been an early precursor to Bovril or Marmite or something. And it's gone. I mean, some of the things that were in the top 10 not many decades ago have gone. The FTSE 100 is probably unrecognisable from 20 or 30 years ago. And as a sector, we've got to move on, which actually allows me to lead into another hot topic of mine, which is that we're not really reaching out to the self-advised private investor as well as we should. I mean, I've noticed one of the boards I'm on, we've ended up with 17% of the share register held by people who haven't got a clue who they are. They're coming through the platforms such as Hargreaves Lansdown. We'd love to reach out, and there must be potential there. Just we haven't gone down far enough in terms of having an investment trust app, for instance. Anyway, don't get me started.
Oh, we'd like to get you started. That would be excellent. This is a manifesto for the future investment trusts. I mean, some of us are doing our little bit to try and get more private investors, self-advised investors involved. But you're right, it's difficult because the whole structure of how you own investment trusts has changed. I wonder whether the Alliance Trust, when you effectively sell your direct contact with the investors in the trust, the private investors, now they're all scrambling to try and get it back again because, as you say, you need to be able to communicate directly with the investors if you can rouse them from their perhaps traditional, I wouldn't say slumber, but they're not particularly actively engaged often.
Maybe we need an influencer.
Well, maybe that's the future. You want a sort of, Beyonce investment trust, whatever. Maybe that'll happen. Who knows? I want to talk about a couple of other sectors, if I may, just throw at you. Renewables, I think, and infrastructure generally are very interesting given what's happened. The election obviously has implications for them, but we don't quite know what that's going to be yet. Because if the Labour Party is going to do even half of what it says it wants to do, it's got to be building out some infrastructure. It wants to be investing in assets with public money, among other things, including trying to accelerate our drive to net zero. And yet here we are, we've got these renewable energy trusts, for example. They have performed on the whole quite well, the ones that have been around for 10 years or so anyway. But they're all basically becalmed now at the moment, as I read it, because they can't go out and raise more equity immediately. Their balance sheets in many cases are okay, they're not overcommitted, but they need more money in order to be able to move forward. What do you think the best case for them is? The government presumably can't ignore them if they want to get more investment into renewable energy as they do. Do you think this is potentially therefore a sector that could be seeing more growth over the next few years?
It's a really interesting one, and the amount of investment that has been made through investment companies into the renewable sectors is really a success story for our industry and the country as a whole. And we'd love for that to continue in future to help the UK meet its net zero needs. But currently you do have some discounts around the 20% mark. What's interesting is some of these funds now selling assets, typically above asset value, which is key to help restore confidence and ultimately sort of delivering on the return profile in the different rate environment is pretty key to restoring investor confidence. But it's perhaps this is the area where you saw a lot of growth through secondary issuance and maintaining that level of demand from investors to get those ratings up towards asset value where they can start to raise capital is quite tricky. But I think you've had an increased focus on selling assets where they can, and it's been positive to see that above asset value and looking to return capital to investors, often through buybacks as a new development, as a case of prove that value and give some of it back to investors. And hopefully that helps balance that supply-demand imbalance to a degree.
There's a lot of issues around the Labour Party. I think I said it's going to lift the ban on onshore wind development, and it also wants to expand massively the amount of renewables that we can be produced. But to do that, they've really got to unlock some of the blockages in the system. For example, with the battery storage trusts, the ones that you just can't get a connection to the grid. And then in terms of wind and so on, the planning process needs to be unlocked. It's not like there aren't challenges facing this sector as well, I would say. One other sector I wanted to ask you about was commercial property. We've obviously seen quite a lot of corporate activity in the commercial property sector. We haven't seen much in the infrastructure sector. What's your view on the commercial property sector and what's been going on there, Ewan? The broad diversified property companies, I think, have to demonstrate their relevance, do they not?
Yeah, you've seen it as an area fall out of favour and trusts go to wide discounts. You have seen weakness in the asset values given the increase in the higher rate environment. You've selectively seen a few struggle due to high leverage, and you've seen one rights issue come in the last week or so. But I think that's been the big difference that we've seen sort of now versus, say, the global financial crisis, where lots of the property funds were excessively leveraged. I think that's was more modest going into this period, which has been positive, but they've certainly fallen out of favour. And you've seen M&A really come in and several of them being taken out either by private investors who've seen the value, but in some cases sort of attempted M&A falling apart and investors just looking to have the assets realised and capital returned over time. So, a fair bit of shrinkage in the sector has happened and might well continue.
I do want to ask you one other question, John, about history. There have been a couple of disasters over the last couple of years. We've had Home REIT and we've had Asian Energy Impact. Home REIT in particular, we don't know quite what's going to happen, but it looks like there could well be some form of criminal investigation into that. In the long history of investment trusts, these scandals are fortunately rare, but do happen. We had the split capital trust problem a generation ago, for example. And there have been others, have there not, John?
There are loads of answers to that one. What I would say is that sometimes third parties can play their part, and I'm thinking particularly of the lenders to trusts when they get into trouble. The split capital investment trust debacle of 2001-2003 took up a huge amount of my life, and what happened on that occasion was that investment companies had large borrowings, and as they got into trouble, the banks called in their covenants and said they wanted their money back, and obviously there are good reasons for that. But what happened in practice was that these investment trusts were forced to sell their very best holdings to repay the bank, reduce the size of the loan, and it had a most unfortunate spiralling effect whereby the quality of what remained got worse and worse and worse, and in my view ended up with the result that the banks lost a lot more money than they would otherwise have lost if they could have kept this vehicle going until markets improved. And I did notice a story this week about one of the trusts you just mentioned, where I saw that the banker had decided to slap on extra interest and so on and so forth. So I think that's a warning from history. Let's work together when you get into a crisis.
And it's also a warning about, one of the great advantages of investment trust is you can use gearing, you can use debt and so on. But you can have too much of a good thing as well. And there's always some people who get found out as the economic or market environment changes. That's for sure.
You asked me about scandals. I have thought about one where Robert Maxwell got his toe in the door with the investment trust sector. Shall I talk about that?
Yes, do, of course. Remind us about Robert Maxwell. I'm casting my own mind back, trying to remember which trust we're talking about. Tell us more.
There have been a couple of instances in history where characters that we wouldn't normally expect in the sector appeared and started taking stakes. And one example I'm thinking of is when Robert Maxwell, or Captain Bob, the publishing tycoon, his organisation built up a stake in, I think it was called Edinburgh US Tracker Trust. And it took one of the board members, an accountant in East Lothian, to start questioning what was going on, because it turned out that once this situation developed, the manager started stock lending the portfolio holdings to other parts of the Maxwell empire, his pension fund in particular. And this chartered accountant put his hand up and said, "What's going on here?" And the manager said, "Well, so stock lending, it's a well-known facet of our sector and we make a good little return from it." And he said, "Well, you've got to get it stopped." And they got it stopped and they got their money back just before Maxwell's empire collapsed.
Well, there's always eternal vigilance is what's required. You certainly can't always rely on the existing structure of the board and everything else, and even the reporting accountants, to spot everything that might be going on when there is a crook like Robert Maxwell around. That's for
But
sure.
it demonstrates that a feisty board that's prepared to ask awkward questions is a colossal advantage for our sector. And it amazes me that the wealth managers in particular don't recognise this as a strength. They're piling their clients into billions worth of open-ended funds. You can't go to the AGM, you can't meet the manager face-to-face. We're offering shareholder protection on a completely different scale to them.
I suppose one of the other points that some people might make was, we used to talk about the magic circle and so on, and there was quite a kind of cosy network of people who found themselves on boards of investment trusts, and that wasn't always particularly healthy. There might be conflicts of interest there, but you're confident that the significant changes we've seen in governance over the last 20 years or so have improved the governance of the sector?
Absolute quantum leap, yes. And we have various shareholder voting bodies who are helping in that regard by, they ask a lot of awkward questions, but that's healthy in my view. So the complacency within the boardroom is a thing of the past and a massive asset for investment companies generally.
And I guess you'd agree with that, Ewan.
Yeah, I think there has been a big step change over the years, and you can ask boards to be more active, and I think there's some cases where they don't act as quickly as you'd like on some issues, but you do see a huge amount of change and reinvention when things aren't working out, which I think is very healthy for the sector, that when things don't work out, then you've got an independent board to sit there and look at the other options, and manager changes, mergers that we've all discussed are coming through at a sort of quicker and quicker pace. And I think that's reflective of boards assessing, is the mandate still relevant, but are there any structural issues with the fund that they've got to deal with? So there's always going to be examples where things could be done a little bit better, but I think the quality of boards and governance is definitely much better than it has been in the past.
So my final question then, I think, for you today, given what's happened this week, it is an election week, as we've said. John, I'm going to ask you this first. You're obviously looking back over many years of the behaviour of investment trusts, and you've made, I'm sure, nice returns from that. Are you one of those who regard this current situation where we have these wide discounts as primarily an opportunity for you, someone who knows the sector inside out? Or are you more concerned about some of the other issues we've been discussing, which are definitely headwinds at the moment?
When I first came into the sector in the mid-1990s, after my former career in the armed forces, I was told these are the city's best kept secret and they will serve you well over the long term. Here we are 30 years later, they're still the city's best kept secret. You begin to wonder whether they're ever going to be thus, and therefore I still think there's tremendous value now, probably more value than there has been for many years, and we should be getting the story out there.
And you'd also agree, I guess. You have a vested interest in this, of course. But
ask an investment company's broker if they think it's a good opportunity. Then, well, yeah, I think I'm definitely going to say yes. Yeah, discounts are wide, and it's interesting to see that almost the people who it's most easy to convince to come back in and take advantage of these discounts and opportunities are often the people that have actually benefited from them in the past. So some of the wealth managers who we saw invest in areas like listed private equity in 2009, 10, 11, when things were distinctly out of favour, and then did tremendously well over the next decade, are the type of people that we're able to convince to invest now. You've got value investors coming into the sector or back into the sector who've sometimes been out for 10 to 15 years or who haven't been in before. So it should be quite instructive that some fairly dispassionate investors who are seeing value are taking very large positions in a sector that's being largely forgotten or neglected by its traditional buyer base.
Well, you're not going to find me disagreeing with that observation. I think it's clearly the case. I think that, in 5 years' time, shall we say, let's assume this Labour government runs for 5 years, probably won't run for 5 years, they really do in first terms. But I think we could be surprised by how the sector will look very different. There'll be hopefully some new names in there as well. And the performance from some of the trusts, which are now on discounts, I think probably will be pretty exceptional. But there'll be other disappointments along the way, of course. So thank you both. We have been talking to John Newlands, the historian of the investment trust industry, author of Put Not Your Trust in Money, The Definitive History of the Investment Trust Sector, and Ewan Lovett-Turner, who is the head of investment trust research at Deutsche Numis. Next week, we'll be back to talking probably a little bit about politics again as we find out what the Labour government's priorities are going to be in practice as opposed to what they promise on the election trail. And then we'll be talking about the latest news, as always, from the sector. Do join us then.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.